Hi, and good morning. Welcome to our live market update. I am Katie Brown, and I'm here with Dennis Morton and Cody Demmel today.
Good morning.
Guys. So our live market updates, this is where we like to share some insights to help you, everyone that joined us today, help give you some different ways to think about the markets and give you some insights into investing. You know, here at Morton Brown Family Wealth, our vision is to have a positive impact on the experience that people have with money, relationships, and life. And so, with that in mind, we hold these sessions to bring our community together and to help you stay informed about what's happening in the market environment around us. We see a lot of familiar faces this morning, so always, happy to welcome you back. And I'm thrilled that we have some new participants here today as well. We want this to be an interactive session, and so we do welcome any questions that you have. We'll do our best to answer them as we go throughout the presentation. If you do have questions that you'd like to post, please feel free to utilize the chat function down below. And as I mentioned, we'll do our best to get to them throughout the presentation. With that said, we have a lot to cover this morning, so I'm going to hand it over to Dennis to take off.
Great. All right, Katie, thanks so much. So good morning, everyone. As you know, if you've attended these things before, we are an anti-prediction firm. We don't like predicting the future. Cody, how good was the Phillies bullpen supposed to be?
They're supposed to be the best. They're the worst so far.
How good are they?
They're the worst.
So, predictions are not useful, good use of our time. But one of the most valuable things that we do is talk about context and put market performance, put the turmoil, the news of the day into some kind of context that makes it useful. That's why we're a planning-focused firm, because the plan is the context for everything that we do. So we want to talk a little bit about market performance through the end of the first quarter of 2024, and also the experience of the last few years and how putting it without context, things might not make sense. So I'm going to switch over to our, Cody, you want to switch us over to the presentation here? I got it. There we go. All right. So if you're a diversified investor and you own some balance of stocks and bonds in your portfolio, which most of you probably do, we're going to look at a proxy for that. The iShares Growth Allocation ETF, the ticker symbol AOR. This fund owns about 60% stocks and 60% bonds. And what this chart is showing you is the performance over the last 3 years. You can see that the overall performance is up 3%. You can see that time in the wilderness, which was 2022, which was a bad year for stocks and bonds. The annualized performance is 1%. And if you were an investor in this fund, you might look back and say, wow, the last 3 years were really not so much to write home about. Weak performance, how am I doing? But then last year, we flash back to this time last year, the same fund, looking back over the previous 3 years. The overall performance was 31% with an annualized 9.45%. That was just a year ago, same fund, 3-year window. So it can be confusing as an investor to think, wait a minute, last year we were still in the depths of a bear market, just coming out of it, and yet the trailing performance was good. This year, the markets have been generally positive over the last 6 to 10 months, but our overall performance is negative. These are the things that can be confusing as an investor when you're trying to assess how you're doing. I think the key is that you have to step back and look at long time horizons. And even 3 years is not necessarily a long time horizon. This particular fund over the last 15 years has averaged almost 8% per year. So a diversified investor holding something like that is getting the long-term returns. But when you start slicing it down to smaller and smaller time frames, it can be confusing. So when we talk today, we want you to be thinking long-term, because that's our perspective as we develop your financial plans. So now I'm going to toss it over to Cody. Let's get kicked off on some of the positive signals we got in the first quarter and some reasons we might have some concerns.
Thanks, Dennis. So as of always, we want to take a balanced approach to investing, both looking for positive signals and also potential reasons for concerns going forward. So some of the positive signals that we've seen over the last quarter so far to start 2024, it was a strong, quarter for investors, especially equity investors, both internationally and inside the US. It was a strong first quarter of 2024. US large cap index returns are driven by more than just the largest 7 stocks. So that is a good thing going forward. Having a broader rally through the entire stock market is a positive. And then one of the other positive signals going forward is there's still hope for a soft landing, even though at the beginning of this year, there were expectations for 6 to 7 Fed rate cuts. Now they bumped that back to 3 because inflation still hasn't came down to that 2% target. So speaking of that, one of the potential reasons for concern is inflation remains elevated. It's above the 2% target that the Fed wants longer term. There's obviously many geopolitical risks around the world right now. So we still have the war in Ukraine, obviously all the tension in the Middle East, and then obviously, as everybody knows, inside the US, we have the presidential election later this year too. And then also one of the potential reasons for concerns is the China economy is still not growing as fast as they want. So that could, impact some emerging market returns over the long haul. And we will go through all 6 of these in a little more detail as we go through this presentation. So sticking on inflation for a little bit, I'll kick it over to Dennis to go over this chart.
Yeah, so what this chart is showing us is the year-over-year inflation rate and the 6-month annualized rate. So we're trying to pick up on the longer-term trends and then what's happening in the short term. And frankly, while inflation has come down, the direction recently is not necessarily where the Fed wants to go. You see that bump up recently in that 6-month annualized rate. That's what's the tension that exists with interest rates, with inflation, and whether the Fed can actually cut rates. I mean, the expectations were for 7 cuts earlier this year, and that's just been ratcheted down and down and down and pushed out further. So the good thing is there's still this steadiness, where the market bounced back starting in late October, early November last year. It was because the Fed said, we're done with being quick. There's no more speed of dropping rates, speed of raising rates. It's much more measured. And that's where it's going to be so data dependent. We're going to have to wait. But one of the things when it comes to inflation and tying it back to the plan is that, well, first of all, your financial plan is not a static plan. It is a process of planning. The variables are always going to be changing. The rates are those rate of return assumptions, the inflation assumptions, all of those things are constantly moving targets. So we're not panicked about any of this, but it does mean that we go back and we check the math and make sure that we're still accounting for all of these variables as they come in. So now we're going to toss it over to Katie to talk about the election year. Or Cody, you're going to talk about this, the election year.
All right. So speaking of inflation and some of the questions that we've seen recently, both from clients, prospects, and also you see in the news is, will the Fed cut interest rates in an election year? So just zooming out, looking at this chart, this is going back to the 1980s, so 40 years. Every single color, I wouldn't really pay attention to the colors, but what they're showing is that was an election year. If you look at the election years over the last 40 years, and the black line is the Fed funds rate, every single election year, the Fed has either hiked rates or cut rates besides one time in 2012. The reason we want to point that out is the Fed's not going to do what, the current party wants or the incoming party wants. They're strictly going to look at what inflation is, what they have to do to get that inflation target back down to that 2% target. So if it means, sticking at these higher rates where we're at right now for longer, that's what they're going to do. And that's honestly what we've seen in the first quarter of this year. As Dennis just said, at the beginning of the year, they were expecting 6 to 7 cuts. Now it's down to 3 because inflation has taken a little kick up recently over the last 6 months. Mm-hmm. So that's why we're still, at the higher interest rate environment.
Yeah, this really shows how the Fed, in large part, has been sometimes behind and then had to catch up with reacting. These are all economic events that they had to respond to, not political events. And I just don't get a sense that there's an appetite for doing anything unless they absolutely have to.
Yep.
All right. I'll jump in now.
All right, Katie.
So, and sticking with the political conversation for just a minute, we are moving into an election year here. We are in an election year here, and that tends to create some questions, sometimes some angst. Regardless of what your party affiliation is, there may be really strong opinions against the other side, and so recognizing that, what we What we really encourage investors to do, though, is to not make investment decisions based on their political concerns, political views, because, and we've looked at charts in all different types of charts. You know, we've looked at charts that will show the markets going up over time, regardless of what party is in the office. This, I thought, was a really interesting chart, because what this is looking at, and this goes back to 1896. But even if we just look in, you know,
Do we have
the
anything,
1900s,
do we have
the
any other charts
2000s.
from the McKinley administration?
But what I think is fascinating about this is, just really quickly visually, you can see $10,000. If you invested $10,000 over time and you only invested along with your party affiliation, your line would be way down here for investments. If you said, you know what, I don't believe in the current administration, I'm just going to back out, I'm going to take a breather, I'm not going to participate, you would be giving up so much. Whereas if you stay invested throughout the various different administrations, the compounding effect is so immense. And just, we really, you know, can't stress enough that no matter how we look at you know, the various political charts and how things move from, you know, one election to another election, it's almost always more economy driven, economically driven than it is the politics of the day, for a whole host of reasons. But just a good reminder, stay invested, let compounding do its work.
It doesn't show what would happen if you invested in the Bull Moose Party in 1912, but we'll have that on a different chart. All right, so moving on from politics, Cody, let's talk about bond returns. And this is, we've noted many times, bonds are one of the least understood asset classes that everybody owns. So just the mechanics of how we earn our returns in bonds is really important. You want to walk us through that?
Yep. So with this chart is a little busy. So if we want to point out just one thing to look at, it's this chart on the bottom left. So what this is looking at is the US Ag, which is the main bond benchmark, looking back the last 20 years. You can see the average return over that 20 years was a 3.2% annual return. If you look at where those returns are coming from, the majority of the returns is coupons. So the yield that you're getting on whether it's treasury bonds, corporate bonds, or some other fixed income aspects, the majority of your return is going to come from coupons. And then every year, there is a potential bump that you could get in principal if the Fed cuts interest rates, or if the yield goes down. People are more likely to pay for bonds that you currently have that are having a higher yield. Then there's years like what we had in 2021, 2022, when the Fed raises interest rates and you can get a higher yield compared to the current bonds. So that's why we see a negative return from the change in treasury yields. Another thing we wanted to point out is the only positive thing that you see every single year over the last 20 years is obviously the yield that you're getting from fixed income. And I know we went over this, I think, in our last quarterly market update, but the expectations, and again, we don't want to predict going forward, but the expectations where you should be able to at least have some prediction for what you should get from fixed income is normally around what the starting yield is. So now that you're getting 5 to 6%, depending on the fixed income aspect you have, going forward, fixed income still remains a very positive investment. Looking forward, especially it takes some of the risk off the table compared to being invested in all stocks. Any other things you guys want to chime in on fixed income?
No, I think this is, when we look for silver linings here for an investor saying, should I put money to work? There's just options out there. I think that's a very healthy thing.
All right, Katie, we'll kick it over to you to go over the first quarter in stocks.
Yeah, equity returns. So we did have a really strong first quarter. I know we've had a little bit of cooling off here in April, and we'll kind of put that in context in a minute as well. But we had a really strong first quarter and strong 12-month returns when we're looking at broad indices here. U.S. stocks continued to lead the way, up about 10%, mostly, large cap stocks for the first quarter of 2024. And up 30% over the last 12 months. So an incredible run there with U.S. stocks. I think what's really interesting, though, in the first quarter is we're used to hearing the big names. We're used to hearing like Nvidia's returns continue to boom, Microsoft, Amazon, but there were some great value contributors as well. Eli Lilly, J.P. Morgan, just we had some Berkshire Hathaway, Exxon Mobil. So it wasn't just the growth stocks that contributed to a lot of the U.S. growth here in the first quarter, and it wasn't just large cap stocks either. We had good positive returns across the world. A 5% return in small caps and 5% return in international, almost 6% international. Those are really strong returns. In any given, if you were to analyze or annualize that, that would make for a really strong year. Not saying that's going to happen because nobody knows what's going to happen, but we had, in some cases, almost annualized returns in Q1.
Okay.
So just don't want to, just want to recognize that across the board, even emerging markets still, contributing. Diversification continues to make a difference when it comes to equity investing.
And Katie, one thing I would like to point out sometimes is that the calendar is still kind of arbitrary. Like looking from January 1st through now, it's a 90-day period. Next time we get together, it'll be 180 days. It's a little bit arbitrary. If you look back to the lows of the market back in October, these numbers look even better for all of these asset classes, like everything, large, small, domestic, international. So again, for context, we just got to be careful with just kind of quarter by quarter numbers.
Yeah, especially because you're right, it's that microcosm. Even as you were talking about the 3-year returns, even a 3-year return, it's a pretty short period of time, and things can get skewed depending on those start dates and end dates. And
yeah. All right, so let's talk a little bit about concentration. So the Magnificent Seven, if you haven't heard that term, that's what we're talking about: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Tesla. And they got a lot of headlines this year because if you look at those first quarter returns, you're getting 12, 18, 82% returns. And that concentration, because they make up such a large part of the domestic index, of like the S&P 500, that's going to drive a lot of your returns. You can see the bottom chart here, you can see the Magnificent Seven's returns versus the S&P 500 without them. So in 2021, which was a big up year, 40% versus 17 for the broader market, 2023, 76 versus 8. And you thought, well, this should have been obvious. We know these companies are growing fast and AI is the next big thing. But look at the risk that you carry. Those 7 stocks in aggregate were down 40% in 2022. That doesn't feel like an obvious win. So we're always thinking about what does it mean to take the kinds of risks that you can sustain? And we use different tools to talk about that. But you sometimes, to get to these 82s, to get to these, even this morning, just timestamp it a little bit, we're pre-market here on April 25th, Meta is down 15% in the pre-market because of their earnings yesterday. So when we talk about growth, whenever growth is driving things, you have to be very cautious about when growth gets scarce.
Yeah.
And suddenly the growth stops. And growth can stop quickly. Not saying it's happening now, but when it does or when it slows down, that sector takes it on the chin pretty heavily.
It also is important to point out that, looking inside of the index fund that you have or mutual fund that you have, what's the weighting that you have inside of these companies? Most likely, if you have, an index that's the benchmark is the S&P 500, these probably make up around 25 to 30% of your holdings. So you still have a large exposure to them. It's not like if you're not holding them individually, you don't have exposure. Most likely, you definitely have a good position inside of these companies.
Yes.
Point. All right, so we pulled up an oldie but goodie here. I don't think we've looked at this in a little while. This is one of my favorite charts. I think it's one of our favorite charts across the firm because it really does help to build context. It looks busy, but what we're looking at here is we're looking at the S&P 500 year over year returns going back to 1980. So 44 years of returns here, and during that time, first of all, 33 of those 44 years have had positive returns. So about 75% of the time, the S&P 500 has positive returns. The numbers at the top of the gray bar, those are the returns for the year of the S&P 500. The red dots down below, those are the intra-year lows. So at any given time, in any given year, you'll see a sell-off. You don't always end where that sell-off is, because as Dennis said, sometimes that calendar period is kind of arbitrary. Anything can happen within a 12-month period, but we can see on average the intra-year drop is 14.2%. So when we start to get pullbacks, even some of what we've given back here in April, it's totally normal. It's totally normal. It's totally expected, and it's good for the market to kind of wash out that risk on occasion. But we can see, we've had years where you're, down 49% and down 38. That was a rough year. But then you have another one where you're down 34 and ended, positive 16. So we can have these large, big swings during the middle of the year and still end up, given enough time, in a positive trajectory, because 75% of the time the S&P is positive. But you have to really need to understand your level of risk tolerance and how much you're willing to tolerate some of that movement to determine how much of this direct exposure should you have amongst everything else within your portfolio.
Katie, you hear so much about pessimism these days, people believing that the economy and the markets are worse than they are. Has anybody been through anything bad in the last 5 or 6 years? There's been a thing or two.
Yeah.
Look, we have had 5 of the last 6 years be double-digit plus returns in the market. 5 out of 6 years. You would never know that from the things that we hear out there and the level of pessimism. So I just think, again, this is part of our job, is to put context in this, and part of our job is to fight for optimism, even when there's bad stuff will happen. All right.
One of the other charts that we just want to go over real quick is diversification. So what this chart is looking at over the last 20 years, the top 50 companies every single year. What the graph is showing is these are the companies outside of the US. So you can see developed market, ex-US, and emerging markets. You can see the average over the last 20 years, 33 of those 50 companies are international companies. So those are companies that are, from Europe or emerging markets. So that makes up around 67% of the top companies every single year are international companies. This is why we want to have diversification, because if you don't have this and you are missing potentially on 67 percent of the best companies, you may potentially be missing out on some returns if you don't have a international or emerging market allocation.
All right. And all of that, we do like to talk about markets and investing. Obviously, that is a large piece of people's financial well-being, but it's not just the numbers in investing. It's putting it in the context of the financial plan. It's staying focused on your long-term goals and really understanding what you need those investments to do for you to help you reach your goals. And it's all about, taking that disciplined approach and saying, I'm going to kind of block out the noise in these other areas, and I'm going to stay focused and disciplined where I need to. And then good investing behavior, of course, too. Making sure that you are rebalancing as necessary, making sure that you're doing things to reduce costs and stay broadly invested and diversified. So there's a lot that goes into the soup, but we just want to make sure that we're not getting too caught up in what the markets are doing on a day-to-day basis without the context around it.
Great. All right, now we're going to spend the last couple minutes. If you have any questions on the material just presented, please feel free to shoot it over in the chat. Happy to answer any questions you might have. But Katie and I are going to talk a little bit about something that we're really excited about for our team. We've covered the numbers this morning, but anytime we're talking about personal finances, the numbers are only part of the story. So if there's one thing we're certain about in our job, is that it's half math and half Shakespeare. In other words, we can explain the numbers all we want, but every one of you listening is going to relate to that information differently.
Yeah. Everyone here today and everyone at large, you all have your own unique money story. You all have your own unique relationship with risk and in a way of defining success when it comes to money in all facets of life. And in understanding this, and in order for us to be effective advisors, It means getting better at having conversations beyond the numbers of financial planning. It's having a greater appreciation for the human side of advice.
Yeah, so this year we're investing in ourselves and our team with the purpose of becoming better human first advisors. So we've partnered with a firm called Shaping Wealth, which is they're a team of professionals across the fields of finance, neuroscience, and psychology. So imagine a financial analyst, a neuroscientist, and a clinical psychologist all walk into a bar and decide to start a business. That's the brainchild is that they want to train advisors in a way that makes it a human first environment in the conversations that we have with clients.
So Dennis and I are currently part of Shaping Wealth's Building the Behavioral Advisor program. And through that, we are part of a cohort of 30 advisors nationwide and actually internationally. And it's a 16-week program that we get to meet up and have really great conversations and learn a lot through the process.
Yeah, so in the program, we're going to be learning to develop deeper client relationships through understanding needs, values, and aspirations. We're going to gain some mastery in positive psychology and behavioral finance to help our communication, help our client engagement. And we're going to fuel some of our personal and professional development by aligning our work with a purpose-driven approach to financial planning.
And this is really exciting because there's an element of the program too that involves our entire team. And so we get to bring the entire team to the table and really work together to not only learn some of these different principles, but enhance our firm's culture and the client experience along the way.
Yeah, so Katie, this is not how we were trained in the business, right?
No.
I mean, when you become a financial advisor, it's you learn about stocks and bonds, mutual funds, and then you hope you figure out the cultural side of it and the human side of it later on your own. But that's just not happening. So we're being very intentional about this. And I think one of the interesting pieces that we already pulled out of it is talking about happiness, satisfaction, and what it means. I mean, this is all how happy are people with their performance, with the markets, with their financial plan. Let's talk a little bit about happiness for a minute and what we've learned about that.
Yeah. So happiness is, just kind of one piece of some of the stuff that we're talking about. But it's fascinating because it can be broken down into like where happiness comes from. And there's a lot of scientific research that talks about, about 50% of your happiness equation comes from like how your personal demeanor, how you were born, just your natural approach to things. Amazingly enough, and this blew my mind, only 10% is from your circumstances. So whether you're born poor or wealthy, if you're healthy or not healthy, where you live, all of those different types of things, events that happen are really only about 10% of your happiness or influence about 10%. So the 40 remaining percent, that's the best part. That's Dennis, if you want to share some of our excitement around there.
40% of it is your choice. Do you choose to be happy about it? And that comes back to that chart that we just showed you a little while ago. Like there are down markets, there are up markets. Do we choose to, the contentment side of it? And part of what we feel our job is to help you with that 40%. Everyone comes to, we talk about everyone walks into a financial planning conversation with an experience with money that they've had. It may have been positive, it may have been negative, it may not have happened at all. But we're going to help you with the disposition that's going to help to provide perspective and really work on that last 40% to define, in Shaping Wealth terms, they call it funded contentment. Like how does your financial situation subsidize your definition of contentment and happiness?
Yeah. That 40%, so much of that is through actions and reactions. So as much as we can be a positive influence on how you're reacting to what's happening in the world around you, and in a positive influence on kind of clearing out some of the noise and filtering the things that should be a focal point for you and your family based on your goals, and trying to filter out the things that maybe we don't need to focus on. I do think that's a big part of our role as financial advisors to help through some of that so that you do have productive actions and reactions to the things that are happening, and that expectations are set in the right spot. I think that's another definition of happiness too. It's reality minus expectations, and recognizing, there are certain things that we can control and certain things we can't control. And if there are things we can't control, then we need to lower some expectations in certain areas and make sure that we are aligning them properly.
Yep, that's that 10%. The things you can't control are the events that happen to you, and
Yes.
just mitigating that impact. So I think to sum it up, we're really focused on defining what a meaningful life is for the clients that we sit across from. Because that's what we're trying to do. Like success or failure isn't was the market up or was it down. It's whether you can accomplish your aspirations with the money that you have. And if you get to that defining meaning and defining purpose, especially as you move beyond the working years or beyond raising kids or go through transition, financial advice is about change management. All of us are going to go through change. Life is always changing for us. And if we can help our clients to understand how all of these outside influences, markets, savings, everything else, feed into your own definition of happiness, then we've done our job.
Yeah.
So we'll pause there. We're up against time. We're going to hang out for a couple of minutes here. If anyone wants to pop any questions in the chat or send us something offline to talk about, happy to cover anything we've talked about or go a little bit more deeper into how our team's going to be going through Shaping Wealth. We really appreciate everyone being here for these quarterly updates. We enjoy them. Hope that comes through. And we'll catch up with you next quarter.
Thank you so much, everyone.
I see we had someone reading up on financial psychology.
Yes.
We should put a book list together. That'd be a good thing to share.
We should. We're getting a pretty nice stockpile.
Yeah. Geometry of Wealth, Thinking Fast and Slow. There's a lot of, although Thinking Fast and Danny Kahneman just passed away in the first quarter. That probably worth mentioning. But that's one of those books that's like everybody cites but nobody's finished. It's and I can attest to that. I think I'm 200 pages in. It's great, but it's
a book of how to think about money or
yeah,
psychology of money.
Morgan
Housel. We talked
Housel.
quite a bit about that. Yeah, some good ones out there for sure.
You bring Morgan Housel in as a guest. We haven't done any guests on
I would love that. We'll let all of you know if we can get Morgan Housel here.
We've
heard him live.
Yes. We've talked about doing guests on the podcast. I think guests on the updates would be pretty fun too. Somebody who does really good predictions. That's what we need.
We're off, right?
What we need, we're gonna get a predictions person, but they have to come on.
All right, great to see everybody. We'll see you later.